Hello, everyone. My name is Tannor Manson. I am the host, the founder, the CEO, the president of the SoFi Weekly podcast. Introducing is just a couple of guests. You might not know them. They don't
Why do you sound like
really.
ChatGPT, bro? You literally
Hold
sound
on.
like ChatGPT.
Well, let me just
He
read my
sounds like
script. I just
that.
asked it to do an intro, so let me read
Tanner,
my
I
ChatGPT
have a
intro.
question. Do you collect baseball cards?
No, and I've told you that's a waste of time. We're in the middle of an
way
intro.
that you just said that, you sound like sports card investor. The way he starts his videos. Identical.
You're derailing me. Okay, guys, introducing in the
Did
other
you say,
corner.
Steven, you want him to rail you? Is that what you said?
Jesus Christ.
In
Why
the
did I
other
wake up for
bottom,
this?
Steve, real quick, can you lift that mic up for me? Just lift it up into the camera. I'm so sorry to do this to you.
Why?
Yeah, can you just turn that around 180 degrees, my man?
Does it really
I-
make a difference?
Very
I knew
much
that
so.
was
Thank
coming.
you.
Possibly also
You can
tilt
hear
it
me
like 30
now.
degrees.
Yeah. Yeah.
Steven, you see this like tilted a little bit to you, just so the
No, away from you.
Okay. Send me a link of what to buy.
Just tilt it.
I'm
No,
going to buy
wait,
a whole
tilt it to your
setup, so I
screen.
don't have to go through this.
Tilt it to your screen.
you have to
To my
act that
screen.
you have to tilt
Yeah, like
the
that.
tip near you. Like let
No,
the tip get
Amit's
closer.
wrong. Amit's 100% wrong. Don't listen to him.
No, let the tip in, just the tip. But let it.
So the sheer mic comes from here. The blue Yeti comes from here. Comes from the front. Don't listen to Amit for audio advice. This guy had a crackling mic for like 6 months.
Hey, I fixed it. What do you think is the catalyst for why the market went bananas when Fed Chair Bullard says we're expecting 2 more rate hikes and the debt ceiling has not been negotiated for a fact? Why do you think the market decided to rally this week?
The market's been kneecapped for the past 6 months. A lot has been priced in from a macro perspective. And I think that, whenever everybody expects the market to go down, that's when you should be looking to see if the market's going up. Biden came out and said, hey, well, if this thing doesn't get signed, then US defaults, we're going to get a 45% dip in the market. Obviously, the market's rallying. I think the second point that you mentioned is more interesting with regards to more hikes. Very recently, consensus was iffy whether we were going to get 1 hike or a complete pause and then possibly 2 rate cuts by the end of the year. What this chart has is meeting probabilities for the Fed. By the way, this was posted yesterday on Friday, and it says interest rate futures now pricing in a 25 basis point hike in June after PCE inflation unexpectedly rises. There's now a 57% chance of a June hike and a 27% chance of another hike in July. Interest rate cuts now not expected to start until November. Only 1 cut is expected for entirety of 2023, while 4 cuts were previously expected. If you'll remember, SoFi and their consensus had 2 cuts for the year. Just 2 weeks ago, no rate hikes were expected and cuts were beginning in July. That's how quickly that can change. It's going to be affecting the market.
Do you think then, Tevis, we get the 2 rate cuts that Noto and team said they're considering in their estimates?
The Fed has now gone down a path of no return because the worst thing that can possibly happen is they cut too soon and then inflation starts to come back up. So they would rather hike for much more for a longer period of time to make sure that this thing is not coming back up again in 6 months or 9 months or whenever, right? And so, but I mean, look, we've seen how fast this information can change, right? Like it said in the post just 2 weeks ago, it was a completely different macroeconomic picture with regards to what the Fed is going to do. So we could be in a scenario, and we know the Fed lags, all of a sudden they've raised way too much, and consensus is that they've raised way too much. If you see some more things breaking, particularly in the banking sector, or another shoe is going to drop, consensus can be very quickly to change after that if they decide that they want to start cutting faster or if they want to start holding it out for longer, right? But at this point, it doesn't seem very enthusiastic that we're going to get 2 rate cuts by 2023. A lot of investors, and look, I don't want to chew my words a couple of weeks down the line, but I think that a lot of investors on aggregate have been acknowledging the fact over the past couple of months that we are out of the woods or starting to see the light at the end of the tunnel might be a better metaphor.
Optimism is definitely coming back, but this is not the first time in the last 2 years where we're starting to see a run back into stocks.
Steven, your thoughts on this market?
My opinion is if they cut, it's not going to be till November, maybe December, but I don't think they're going to do it. Powell and the Fed was behind the whole time. They were wrong. Everybody was wrong on transitory. It became a big word, transitory. You can't have oil at 130 and 140 a barrel and think that inflation's transitory. That's not how economics works. Oil and gas are the biggest inputs for manufacturing. They are the cornerstones for plastics. They touch every part of our lives. That goes up, the feedstocks go up. Phosphorus went up and fertilizer went up. Phosphorus is a very large component of fertilizer, making food costs go up. Powell cannot be wrong again. Like Tevis said, the worst thing that Powell can do is cut and be wrong because they were wrong the whole time. He has minimal credibility right now. He's not going to go to zero. They're taking a hard stance, and I just don't see cuts coming down the pipe in August after Jackson Hole, September, or October, because if they get it wrong again, I think that that's a card that they will not play no matter what. They're going to do everything to protect that.
When you think about that, just psychologically speaking, right? The safe play is just, hey, let's just wait it out another couple of months before we cut, because once we start cutting, we're going to be on a path towards cutting further. And the market is going to know that, right? And the other thing that I want to add is like, they can't really signal to the market that they're going to start cutting because immediately the market is going to preempt that and go on a bull run.
Noto did a fireside chat with JP Morgan Chase. A lot of things were addressed.
This was probably the most exciting chat that Anthony Noto has ever done.
Before we actually even go into the contents of that JP Morgan fireside chat, Anthony Noto did 2 talks this past week. He did one with Mad Money with Jim Cramer on Tuesday. Jim was sort of throwing him some softballs, what it seemed like to me. These questions that immediately addressed the $2.5 Wedbush price target. Anthony Noto got these questions again at the JP Morgan fireside chat just a couple of days later. And so I think that a couple of retail investors on Twitter were talking about the management team coming out, addressing this $2.5 price target. I realized once I was doing that video for JP Morgan Fireside Chat, this is the response. They can schedule PRs. I'm sure SoFi as a company has input in terms of the questions that they're asked.
He's definitely a listener of the SoFi Weekly, is what you're saying. He listens to all the points. He reacted to practically everything that we had a problem with or any of the guests had a problem with. One of the things that I thought was very cool is talking about deposits that were still growing. They're expected to do over $2 billion. They're still holding up about 90% of deposits are coming from direct deposit users. One of the more specific things, though, is he said a lot of the actual growth, what they're seeing in customers and everything like this is actually coming from large financial institutions, the Wells Fargos, the JP Morgans, the Bank of Americas, and didn't actually come from a lot of these collapsing regionals, which is what a lot of people thought. Oh, this is just a short-term bump, due to the collapse. No, actually, he said it's still coming from the big names, people that are making the jump.
If people are coming organically to this product, it means they're seeing it genuinely as the vision that they are portraying to shareholders, which is this one-stop shop for your finances.
I was not a fan of SoFi Relay. Now I've come to realize that that is going to be their biggest product. I guarantee it. End of this year, it'll be their biggest product. It's the fastest growing product this quarter. It'll blow past SoFi Money and SoFi Invest. It's what allows them to get so much details to even attract customers for other products. Like you can see what their spending is, if it's going through credit cards, savings accounts, high interest, if they have personal loans, if they have a mortgage, you can track that, see how much they're paying, when it's coming up for renewal, and then offer them a perfectly timed offering at just a lower amount to totally entice that customer.
Relay is really the data play. He literally said that on the JP Morgan call when talking about Relay. He said, hey, look, this is growing really fast, but more importantly, we gather all of this data and we leverage that data within our ecosystem. And that is a really important component to drive that flywheel of growth and the cross-selling even further.
They're doing auto tracking now where you can track all the prices of your cars and everything and the value of how that's trading on the markets. And I just think about what's happening with SoFi Travel, which they were talking about as being a very successful product even already. They want to get into event tickets, concerts, sports bookings, and match up with other partners and then sell those products through the bank. Obviously, SoFi will get an interchange rate for that because if it's anything like the SoFi Travel partnership, you'll need the SoFi credit card in order to do it. This is a new way of looking at it versus any other bank.
The cutoffs they have for loans, I think we knew they were pretty aggressive with it and fiscally responsible. I didn't know they were this responsible. either you got it or you don't got it, which is basically the sentiment I got from
Well,
Noto.
And they tightened it this
yes
year.
and no. If you're under 680, then they cut it. But if you're over 680, then they'll look at your cash flow. They'll look at how much debt you have. They'll look at, how fiscally responsible are you as an individual, and then they'll make a judgment call off theirs.
One other thing is the 70% of people that we reject from loans. I didn't know this. There is a affiliate marketing program we have where we send them to other people and we get a commission.
We have a partnership with Pagaya that actually refers loans to other people.
People seem to think it's a bad thing. SoFi hasn't sold their loans. They are bringing in 6.5% of those loans compared to 5% selling them. So yeah, maybe we should transition to the selling versus holding the loans on the books. Steve, do you want to take this one first, or?
Anthony Noto, this is not the first time that he has explained why they are not selling loans. Their job is a stewardship of capital and to generate shareholder value. They feel that they can generate more shareholder value by holding the loans for investment rather than going to the market and selling. It creates an extra 2%. I'm not going to argue with their actuarial models that have actually been very, very tight. They are well under their accepted risk level. There are companies that sell loans and there are companies that hold them for investment. SoFi is well capitalized. They are holding them for investment.
Why are they getting the 6% versus 4%?
The rates are expected to go down.
And also, yeah, if you're going to sell a loan that's already matured a little bit, people want a premium on that loan in order for them to take it. And there's also an opportunity for default. The premium will go down because people need to take on some sort of risk.
The biggest thing on the lending side that I'm worried about is if we do start hitting our capital ratios, can't continue to grow the loan book, and there's still no demand for loans, it means that the growth will slow down. I don't think SoFi is at risk of like high delinquencies derailing the entire company and everything goes to zero and they're going bankrupt. They're just too well run for that, and their underwriting is too tight. But there is a risk that you get down to, 10, 15% growth because you just can't originate more loans because you can't get them off your books and you've hit your capital ratio constraints. That's what would possibly lead to slowing growth. And if you've got a growth company that's only growing at 10%, the stock price is going to reflect that.
Pretty long ways to go, though, for ratios.
We do. You could probably carry another 5 to 6 billion and still be around 14%, which is probably where we want to be at about long term. We held 3 billion extra loans last quarter, personal loans. You do that for 2 more quarters and you're pretty much at your limit if you don't sell at all.
The best way that it was put, at least recently that I read, was from IP Banking Research. I don't agree with this guy 100% all the time. What he sort of said was there's 2 different ways that they can do this. They can either do the fair value accounting, and then we get to see as all the money sort of ticks off the loan. Anthony Noto sort of said this during the call. He said the way that they actually look at their delinquent loans is that after 10 days, they have to mark down the loan by 35%. After 30 days, they mark it down by 70%. After 90 days, by 90%. After 120 days, the loan is done. Whereas the other banks, what they do is they mark it off before the loan even starts. That's what the CECL reserves are. But that being said, banks already do this whenever they actually do take the loans, and then they actually mark it between around 7 to 8% right now, very similarly to what SoFi is expecting. It's just a matter of whether you're going to do that before you take the loan or after. The amazing thing that I like and that wasn't brought up is that it's still easy to hide your problems. If it does get worse than 7 to 8%, no one needs to know because you're supposedly holding the loans till maturity. So you don't need to actually mark to market those loans. So you can actually wait until a forcible sell because people are actually leaving the bank. That's what happened with Silicon Valley Bank, right? And then once they actually had to sell a large chunk of their assets, then we got to see that they were not marked anywhere near where they should be, and there was massive problems. That will never happen in SoFi's case because we will see the house collapse as it's actually going on. You'll be able to see the red flags as they appear. It's actually a large benefit to SoFi, in my opinion, but some people say it's actually not that big of a benefit if you already mark it off to begin with. We've already assumed that Galileo and Technisys were going to be a massive benefit when put together, but now he sort of talked about how it already is. So they weren't in talks with any large banks before because Galileo just wasn't the service that they were looking for exclusively. But now he said they're in with over a dozen plus large institutions that are facing end-of-life technology. This is obviously great. We're in talks. They've even said they're already in the proof of concept with a really large U.S. financial institution. They said that on the earnings call. But they did say it's going to be moderate growth in the tech platforms for a little bit as whenever these new institutions do switch over, they only start to bring over their new customers, which, as we know, they are still only going to bring on so many customers over time. And then once they actually see that this is a true product, they know how to use it, then they will start to pour over their old large, cohorts of customers. That's when the real money will come. So they still said expect for probably the next 3 quarters for it to be moderate growth.
One of the other things that was interesting on the tech platform, he again mentioned Silicon Valley Bank and First Republic, and he was saying that a lot of these regional banks that collapsed, they didn't have real-time asset and liability management, whereas SoFi, as a result of their tech platform, has this technology embedded where they can see deposits in real time by the minute, split up by different segments. My light just crapped out. Where they can actually have a much more comprehensive view, which is obviously a testament to their tech platform, and it's something that they can sell as like a white label point to other institutions as well. Like, hey, all of a sudden now you can have real-time in-depth analytics split out by your cohorts.
From this institution, they reported that approximately 80% of financial institutions run core banking systems they built themselves, which means much of the architecture was designed in the pre-internet era for physical branch banking. Anybody who has done any work in SQL systems or run any type of programs that were built in-house, they continue to have to make Band-Aids and Band-Aids and Band-Aids and utilize different APIs. It is a headache to keep it up with evolving technology. Eventually, you will need to rip and replace, because banking today is not the way banking used to be. It is much different, and the legacy systems are not going to be able to handle what the customer demands in the future. When you think about customer demands of the 1980s and the 1990s, there were not smartphones. You had to go to a physical bank. You could not deposit a check by taking a picture of it. Skip to 2023, most people, I would think, are utilizing a smartphone to do a majority of their banking. Also, think about what it was like closing an account and reopening an account versus today. The technology side of a lot of banks has to change and probably has been going through serious upgrades. And the fact that in a matter of weeks, it's gone from we're in proof of concept with one large financial institution to we're in talks with 12 large financial institutions is very promising. The question that I always think about is, what companies have the entire back end to build this product? I'm not coming up with any. There are companies that have parts of it, but I don't know any companies, and I've done a lot of research on it trying to find it. I don't know any that can do everything that SoFi can do on the back end. So this could be absolutely huge in the future and pay off reoccurring revenue in spades. And what's it worth if SoFi ends up being a winner take most company, actually supporting and underpinning a large portion of the financial system?
Noto also said on the webcast, he said, the tech platform pipeline has been the strongest they have ever seen since he's been at the company. And the TCV, the total contractual value, is also the highest Anthony Noto has ever seen.
Some of the Galileo employees, so Derek White, the CEO, and at least one other, have gone on podcasts in the past, and they've talked about how in the entire banking sector, there's one technology that a significant amount of the legacy institutions use that's going to be going offline in the next few years, and that all of those systems are going to have to be replaced. I am sure that they are pushing really, really hard on those particular institutions, right, that they know have deprecated systems that are going to be phased out in the next few years.
But is it the COBOL thing that Doug has said?
Yeah.
Is this what they're talking about?
So COBOL is development language that was started in the late 60s. That's what the entire banking industry is. That's what money is.
That or Fortran. One of the more useful pieces of chemical engineering software that you use is called Aspen Plus. It's built in Fortran like back in the 70s, and then they keep doing Band-Aid fixes. It is so frustrating to use. I use it every day. But here's an example of what Tevis was talking about. I cannot open a file that has a file path that is longer than 136 characters because it's built in this old technology. And it also makes it so, here's another point, you cannot have any cloud synced files or it corrupts the files immediately. So as you're working on it, you'll get a corrupted file and then it will no longer work. It makes everything harder. It makes everything more expensive. It makes it so that we spend so much time just troubleshooting the program rather than actually doing our job, because there is no Galileo and Technisys in this case.
Is this the language that's going offline?
Yeah, so it's not necessarily the language. It's just that they have to rewrite their applications onto another language that's more flexible, more comprehensive. The language is still going to exist. It's a language, right? Or they just plug into Galileo and have everything out of the box.
Is it a regulatory reason why they're not allowed to use this? Why would they be forced to change?
It is regulatory. Like banks are required to maintain certain standards from where they need to be and what the threshold is. The problem is, as a lot of these things get outdated, if COBOL is from the late 60s, you can count on one hand the developers who are actually proficient in this. No new developer is learning COBOL. And so it's increasingly more and more difficult for a lot of these places to find actual competent developers to patch these fixes up. It's so risky to keep it on this like legacy infrastructure. People tune out the moment you start talking about like application interfaces and coding languages. But just that example that Chris brought up is a limitation of that legacy language. If you go from COBOL to Python, like what most backend systems are built that are best in class today, it's like the most popular coding language on the backend. Every developer can code in Python. All of a sudden, you unlock an entire pool of new devs. It's much more flexible. There's much less risk of downtime. There's much less risk of, data corruption. With Galileo's out-of-the-box components, you could just plug and play because everything speaks to each other, right?
I want the tech platform to become what we all think it can. And the fact that it declined quarter over quarter, I mean, I understand if your second largest client leaves, right, it's going to hurt. But more than that, the fact that it had been flat for 3 quarters in a row and then it went down, right? So it wasn't just that it was like one quarter where you lost a big client. It was also the fact that revenue had significantly decelerated. And honestly, even with the way that he talked about it, these longer sales cycles, the fact that they're going to be bringing on people, only new accounts, and then slowly bringing over the legacy accounts means that we probably won't know until mid-2024 how this all plays out. But the way that he's talking about it, the additional detail was really important for me. And there's so little in the 10Q about the tech platform.
SoFi itself also started implementing 2 of their products, the payment risk platform, as well as Connecta, all the things that it's already starting to do, reduce the cost per contact, increase customer satisfaction, can just easily be done on AI. It might as well just be a ChatGPT of a frequently asked questions, if that makes sense.
When everybody thinks about AI, they think about the B2C applications with regards to the chatbot. But Anthony Noto was also touching on what it can provide them from an anti-money laundering perspective, from a regulatory point of view, and from like a overall cleanliness point of view. Really interested in the anti-money laundering section. They sink a lot of money into that. And if they can automate a lot of that with AI, whether it be Connecta or something in the wider Galileo ecosystem, it's just another value proposition for having this all plug and play.
And it goes past that. It's if they can make the compliance aspect easier and more frictionless, what's that worth to companies?
Anthony Noto said that I think it was by 2025, he sees members growing to about 800 to 1 million new members per quarter.
In 2024, he expects it to double, if not even reach 1 million. So that
by 2024,
and I could be wrong, but I think this is correct. He said if we can hit those member growth numbers, I wouldn't be surprised that by 2025, 2026, we'd have 20 million members. And then we can start vying for a top 10 spot in terms of global financial institutions.
That would mean 31 million members by 2030. Pretty insane. If they actually get to those rates. The other thing that was interesting to me about this is that that means they believe the organic marketing they're doing is going to be enough to be able to attract that many more millions of people, which means, I don't know if they have to buy another stadium, but they're probably going to have to do a lot more stuff on the marketing spend. I don't know what exactly that's going to be. What do you think was the reason they believe there was going to be that inflection rate of growth? Because outside of increased spend in marketing, how do you get to 1 million members a quarter?
Think about the stats that have gone off about millennials and the younger generation. How many of them are going into the job market?
Yeah, look, so the macro trends are the macro trends. They're going to be there in terms of like generational demographic shifts. Don't forget, SoFi is handicapping their own numbers right now. They're lowering sales and marketing spend. They're being really selective around the FICOs. The moment that the Fed starts lowering rates and it gets a little bit less precarious on a macro level, they have the ability to open the floodgates and even let more people in, because they're not going to be as scrutinous over the FICOs, because there's a lower risk overall of just generally defaults and things breaking ground in the banking industry.
And also, humans are really, really bad at understanding exponential growth. So how much easier is it if you start to rely mostly on referrals? Right now, we've got 5 million members, right? We're getting, 2 years ago, it was at 3 million or 2 million members, right? So just the referrals, you get, twice as many referrals from 5 million as you do from 2.5 or
That's a good point.
2.5 million, right? And so it starts to build on itself, and you get this nice exponential growth. But as a percentage, it's still lower, right? So we had quarters where we were growing something like 18% quarter over quarter. And 18% quarter over quarter right now would be almost 1 million members, because we're above 5 million members. And so, well, obviously, like the rate is going down, right? We're not going to get 18% growth quarter over quarter. But if you stay at 9 and 8 and 7, once you're at 20 million, if you only have 5% growth, that's still 1 million members a quarter.
In that same breath, Anthony Noto was talking about global expansion.
I hit the second
This was
point.
my favorite point.
Global expansion for SoFi in the long run.
He is so happy. Oh my God. You haven't been this happy the whole time.
Well, because he
Finally has a real competitor to Nubank.
Yeah, no, it very specifically said LATAM. I think that they already have such a strong presence in there with Galileo and Technisys, what they said. It's just funny because it has nothing to do with how their actions have actually been, right? They were Hong Kong, and then their Bender 9000 found
United Arab Emirates.
Yeah, United Arab Emirates and Singapore.
When he was talking about where he wants to see them in 5 years, he said, we want to be a top 10 financial institution by things like market cap that banks are measured by. So he actually said specifically market cap. And if you go and you look at what are the top 10 financial institutions in the United States and what are their market caps, number 10 is Truist, which has a market cap of over $40 billion. So from where we're at right now, that's an eight bagger in I think he was talking about 2025, 2026. So,
Noto's incentivized to get to 2025 by 2026.
Oh, he's incentivized to get to 45, right? If they get to 45, Noto's net worth increases by something like $200 million. The only way to grow capital would be to either through debt or through equity. And so you're looking at dilution at that point. And I don't want more dilution.
Unless we're profitable.
But yeah, so that's the big deal. And I've been thinking about this more recently. GAAP profitability is important for investors right now because look at Palantir. Right. Yeah. Interest rates are high. People want profits now. They don't want profits later. So that's important. But actually, I'm okay with sacrificing a quarter or two of profitability for additional growth that pays off down the line. That's me personally in my investment style. But SoFi is a different beast because of the reason that Tannor just said. So one way to increase the amount of capital you have is GAAP profitability. So you have retained earnings that allow you to just increase the capital. It's important because at that point, if you're bringing in $100 million in GAAP profitability every quarter, what that means is that you can originate an additional $700 million because your capital, if you assume a 14% capital ratio. And so it allows you to continue to grow that loan book and to continue to run that flywheel and get additional net interest income in the doors because you're building up your capital ratios.
That's just leverage, by the way, for the capital ratios, right? You don't need as much, hold as much. It's levered to a great degree.
So you think if Noto has to flick a switch to get GAAP profitable, he's trying to do it in a way that when he does it, he thinks they've captured enough market share doing what they could do without being profitable. Because once you flip that switch, as you said, as the capital ratios increase, there's a whole nother sector of growth that could happen. But there's a reason we haven't become GAAP profitable yet.
Thing is that we could be GAAP profitable tomorrow. It's just, you don't want to see new users next quarter be zero. They're still trying to get to those milestones without completely flicking off a certain segment of their business.
All right, everybody. See you next week. Bye-bye.